and thank you for joining us for another presentation. This is Rene Ruiz with SoCal Purchase Loans, and today I am diving into how your interest rate is determined. Now, what is the relevance? Well, everybody wants to understand how their interest rate is determined, and that's because everyone's interest rate is a little bit different. Everyone has a different application. And also because some factors can be controlled based on the information that you will gather today, you can make some changes to try to improve your possibilities. And that is really the intention, to help you identify opportunities that will improve affordability. Here's the big concept that you have to understand. It's called risk-based pricing. And here's the definition from the Consumer Financial Protection Bureau. Risk-based pricing occurs when lenders offer different consumers different interest rates or other loan terms based on the estimated risk that the consumers will fail to pay back their loans. Now, if you have a higher interest rate, it's probably because you were viewed as higher risk. And if you have a loan or an applicant that is less risked because they're better qualified, well, you would expect that that person would get a lower interest rate or a lower price for the same interest rate. Here's the risk factors that they focus on, that the lenders and underwriters will use to determine your interest rate. Number one, credit scores and credit history, and I'll go into detail for each category. Number two, intended use for the home. Number three, property type. Number four, equity position / down payment. Number five, qualification type. And finally, number six, debt to income ratio. Here's the first category. As far as credit scores and credit history is concerned, the major thing that the lender is going to look at is going to be your credit scores. And obviously, lower FICO means a higher interest rate, because when you have a low credit score, it means that you are higher risk. If you have a higher FICO score, that means that you've done a great job paying on time, and therefore you're viewed as lower risk, which means you're going to get a lower interest rate or lower price. The FICO scores are viewed in tiers or brackets. Like, for example, the tiers go in 20-point increments. From 600 to 619, you're in one category. From 620 to 639, you're in another category, and on and on and on, until you get to about 740, where most agencies will put you in the top bracket. However, private investors will go to 760, 780, which means that if your scores are higher up there, you can get a better interest rate. And as far as derogatory credit events go, there's some lenders that if they see you've had a foreclosure or a bankruptcy or something negative on your credit history, whether or not it has affected your scores, they might change the pricing, because now they know that you've had this event and they can view you as higher or lower risk. What about property use? Well, what we mean by that is what you're going to do with the property. If you're buying a property and you're going to live there as your primary residence, that is viewed as the lowest risk. Next is going to be your second home or vacation home, and then finally is going to be investment property. And the concept is pretty straightforward. If you lose your job and you can only pay one of the three mortgages you have, are you going to stop paying the rental? Are you going to stop paying the vacation home? Or are you going to stop paying the primary residence? Well, most people will stop paying the second home and the investment. And for that reason, primary residences are viewed as a safer investment for the lenders. Property type. Well, this one's a little more complicated, but as far as the priority goes, single-family residences are viewed as ideal. Next in line is going to be manufactured homes, although if you end up buying a manufactured home that only has one it's a single wide, then you might end up with a higher interest rate. Condos are going to be next in line, and generally, if you're buying a condo and you're doing 25% down, you will get the same interest rate as a single-family residence. But if you're doing less than that, the interest rate gets marked up considerably. And for the most part, at least on conventional loans, the interest rate on a condo is usually a quarter to 3/8 higher than a single-family residence when everything else is equal. And last, multi-unit. Multi-unit properties tend to have the highest markup, especially because most of the time you can't even do a multi-unit as a second home. It has to be an investment. Sometimes you can't even do them as primary residences, depending on the circumstances. And to kind of expand on the concept, well, and back to condos actually, why are condos considered higher risk? Well, fact is, if your HOA mismanages funds, ends up bankrupt, it could affect the value of the property. And therefore, the bank sees that as higher risk. Next category, equity position slash down payment. Of course, if you have more equity, the bank is going to feel safer. The amount of equity that you have in the house is the true collateral that they're counting on if you don't make your payments. If you end up in foreclosure and the bank has to take your house and sell it, the more equity you have, the more likely it is that they're going to get all of their money back. Not just the payments you missed, not just the amount that you owe on the loan, but all the attorney's fees and everything else that'll come up during the foreclosure. And secondary financing. That means if you have a second home equity line of credit, if you have two mortgages, then the interest rate is going to be affected on the first. Most people buy a house and they just get one loan and they don't have a second, there's no impact. But if you're buying a house, for example, and you're getting one loan for 80% and you're getting a home equity line of credit for 10% and then putting 10% down, well, the interest rate on that 80% loan on your first mortgage is what we call it. It's going to be lower than if you didn't have that other 10% home equity line of credit. So we call that the CLTV, the collective loan to value. And if you do have secondary financing, it will affect the rate on the first. Next is qualification type. This one's pretty obvious. If you're going to qualify full doc, you're going to be less risk. You're going to get a better interest rate. Next is limited doc, where you don't necessarily turn in a full package. You just show W-2s or maybe just a first page of a tax return. Next is bank statement programs. For the self-employed individuals out there that write everything off, sometimes this is the only way to qualify for a purchase. Well, technically, those people end up getting a slightly higher interest rate because of the type of program that is being used to qualify. Next is debt service coverage ratio. Those are the loans where you qualify based on the rents. Well, that happens to be an investment product, and that means that you're doing an investment property, and that means that you're going to end up with a higher interest rate because not only is the property going to be investment, but you're qualifying using the rents. You're not using standard qualification. And last, no employment loans. Most people know these as stated income loans. At least that's what they used to be called. These days, it's just a no employment loan, flat out. If you can come up with enough down payment and enough in reserves, right now the magic number is about 35% down in 6 months of reserves, then there's no questions asked. The bank's not going to ask or care how you make a living or how you pay your bills. They know there's plenty of equity there and they'll just give you a loan. But you're going to get the highest interest rate out of this whole category that we've gone over. Okay, here's the last one, debt to income ratio. Recently, Fannie Mae and Freddie Mac announced that if your debt-to-income ratio is over 40%, your interest rate or the cost for the same rate is going to be higher compared to the next individual. This is something that the industry is pushing back on. Not a lot of people are happy about this, so hopefully it changes, but for the time being, it's something that is expected to go into effect in the next 30 days. And last, this is more or less kind of on the side, certain private investors, and we're talking like jumbo loans or the non-QM stuff, those investors have different DTI requirements. I mean, the best interest rates you're going to find are probably going to have a lower debt to income ratio ceiling than the other programs that are out there. And what I'm trying to say is that if your debt to income ratio doesn't meet the requirement for some of these private investors that have the best interest rates, then you're going to be precluded from being able to get those loans. So that's another way that your debt to income ratio can affect what the interest rates are that you're going to have access to. All right, a couple important things to remember. Different lenders have different products, and they have different rates for the same products. I mean, you can go to Bank of America, Wells Fargo, and ask about their 30-year fixed, and they're going to have different interest rates. And that's just the difference. Some companies have more expenses for marketing, different profit margins, different viewpoints on what the economy is going to be doing, and for that reason, you're going to see variances in their prices and rates. Also, application volume has an effect on rates and price. If you think back to 2020 and 2021 when we saw the lowest interest rates, I remember clearly that some lenders were increasing their interest rates based on how busy they were. Think about it. If you cannot handle any more business, but people are still applying, why not increase the interest rate and make more money off the applications that are still coming in? And I promise you, when the lenders were doing that, people were still submitting their applications. I mean, at one point, the market was somewhere around 2.75 for a 30-year fixed at par for most people. Some lenders were putting their rates at 2.875 or 3%. And people were at 5% refinancing down to 3%. They still saved a ton of money. So that's something that you have to keep in mind. That also goes in the other direction. If it's really slow, you might see some lenders reducing their margins to try and keep their employees busy. Specific risk factor criteria differs for conventional loans versus FHA loans versus SBA loans and jumbo investors. Really, what you need to know is that you don't want to assume that because an interest rate improves on a conventional loan from a 680 FICO to a 700 that it's going to be the same on a VA loan. I think on a VA loan, going from a 680 to a 700 doesn't make any difference. So lean on us for that. We will give you recommendations every single time that someone applies with us. We look at all the programs they qualify for, and we tell them this is what we think is going to be best. So don't feel that you're going to have to figure this out for your clients or for yourselves. Thank you, everybody, for watching and for your partnership. We really, truly appreciate you trusting us with your business. If you have any questions, please don't hesitate to reach out. And as always, I'd like to remind you that if you can think of any videos or topics that you'd like us to do and dive into, we would love to do them for you. So please let us know. Thank you, everyone, for your time, and make it a great day.